In this video, we're going to be talking about the 3 stages of the buying process and how it relates to your upcoming capital raising. So firstly, let's do a deep dive on this, right? So one of the reasons for the last couple of years, I've spent a lot of time trying to understand what the science of an actual capital raise is. So what was important as part of that process was to understand also what the buying process is. So I come across this, I can't remember where I was looking for, it was something related to marketing content. And then I realized, and one of the things we all often talk about is how capital raising is a combination of a marketing and also a sales process. Right? Because obviously the first step is the generation of interest. The second step is moving towards someone making a decision, right, to invest. So really, there's no different between, an investor deciding to invest into a company as to any sort of other buying decision. There's certain things that they're looking for in that. So really what we understood was the process, right? The first stage of a buying decision is awareness. So for most companies, what happens is they want to go from, when they go into their capital raise, they want to go from the 3 stages are awareness, consideration, and then a decision, right? Now, in most companies, when they think about capital raising, they often think about going straight from awareness to decision, right? And so what that means is they're effectively not thinking about all the different steps that go along in that process of that consideration part and what that means. Now, also, if you look at the way in which investment bankers and corporate finance houses run IPOs, you'll realize that their process also follows this pattern of awareness, consideration, and then also decision. So a couple key things under the awareness tab, and I'll break down under a different video. But for me, this video is just really helping you understand that what are these 3 stages of what a buying decision is. So when you're going into a capital raise, it's important to know at which stage you are at. So if you're at the awareness stage, effectively what you're trying to do is you're trying to gain momentum. You're trying to get that lead investor, or you're trying to at least get the first stage of your capital raising past being that sort of 50% allocated, which is typically the marker, which makes it a lot easier for you to raise the rest of the money. So first thing, awareness, where are you at? Now for us, the way we've sort of tried to communicate to companies is that that when you're moving from awareness to consideration stage is typically when you've got 30 to 50 plus investors actually in your deal room, right? Because when you're in that awareness stage, you're trying to have you're trying to speak with as many investors to understand who's most likely to become a shareholder in your company. Then moving into the consideration phase, the idea is that you want to have some sort of momentum, right? Because if you understand the psychology of investors, firstly, no one wants to be the first one in, no one wants to miss out. Then the other part that tends to happen is the bandwagon effect. So if you'll notice, a lot of VCs like to actually invest together. Exact same thing with high net worths. So if you're in that consideration phase and you have a lead investor come in, or you have a renowned investor in your space, or you have something significant that happens from the investor side that can make a difference, effectively what you can then do is you can then trigger the bandwagon effect from a psychological standpoint, right? Where more investors think, oh, such and such has gone in. Okay, I want to have a look now. Or there's investors that collaborate together. So typically you find that VCs, family offices, and high net worths typically like to invest together with other friends or other networks or other colleagues that they've done deals with previously. So first stage is awareness, second stage is consideration, and then the third stage is actually the decision-making stage. And really at that point, what then happens if you notice that whether it be a fund, right? Typically for an early stage fund, they call it a first round of closing, right? The first closing of the fund. What that does is it creates a deadline. It helps the deadline to actually put pressure on the actual process. So as human beings, we typically will delay things as long as we possibly can. Once a deadline is set, then typically our mind will start to work towards that deadline. This is the same for both us as a company, and also this is the same for you, for your investor as well. So the 3 different stages: awareness, consideration, and then the decision-making stage. In the awareness stage, you really want to make sure you have as much visibility as possible and you're leveraging off your key capital raising brand points. Then the next stage is when you're going through the consideration phase, you want to have multiple touch points with a potential investor so they feel like they really understand and have gotten to know your story, even if it's in a short period of time. If someone is interested, they will spend the time to get to know as much as possible about your business. And then the last part is the decision-making phase, where You need to create a deadline and then work everyone to that deadline to help ensure that the capital raise gets finalized. So they're the three stages of a buying decision as it relates to any sort of decision, but really as in talking about how it relates to capital raising. So I hope that was helpful for you. On future videos, we're going to be breaking down each one of those three different stages and what you can do to empower your capital raising.